Hello and welcome to this special State of the Economy show. I'm Lata Venkatesh. The immediate news that hit us is the CPI inflation for the month of December. It has inched up to 1.33%. This compares with 1.6% in the CNBC TV18 poll threw up. The food deflation is the major factor. That's come in at minus 2.7, which is, a trend that we've been seeing for the last 7 months. Negative or rather falling food prices. This compares to a minus 1.7, which is the CNBC TV18 poll threw up. The CPI data is the last number we are getting before the February 6th RBI policy decision. And therefore, let's decode the numbers with our guests. We are joined by Suvadip Rakshit, Chief Economist at Kotak Institutional Equities, Aditi, Nayar, Chief Economist at ICRA, Devang Shah, the Head of Fixed Income at Axis AMC. Also from another mutual fund, Srijit Balasubramanian, the Senior Economist, Fixed Income at Bandhan AMC. Gentlemen, and Aditi, thank you very much indeed for joining me. Aditi, the inflation has again surprised a little lower. Our poll threw up 1.6 and there were quite a few people between 1.6 to 1.7. So should we expect further falls in the coming months too?
Thanks, Lata. Actually, we are not that surprised. Our number had come in at 1.4%. That's where our forecast was. So it's only marginally lower than what we had expected. And I think now the food deflation trend should slowly be easing off. And we are expecting the next print to be somewhere above 2%. So at least it will come back to within the 2 to 6% range of the MPC. And then gradually continue its upward trend. Of course, all these forecasts are based on the current series, and we'll be moving to the new series very soon.
Oh yes, I immediately after asking you, I realized it was an unfair question because the Reserve Bank's forecast of Jan, Feb, March is for the old series, and we do not know what the new series will hold. Suvadip, anything surprising in the numbers? Is food inflation lower than you thought? And do you think that we will be in for a lower surprise if the old series continues?
Sorry. I think the first point to note is that if you look at the high frequency numbers in terms of the food prices, etc., I think it was pointing slightly on the higher side. So we were expecting a slightly higher print on food. However, the actual is much lower. And I think this is a good print to go into the February policy, fully acknowledging the fact that the series will change when the next inflation print comes in. But having said that, the RBI will be going into the policy with this particular number, with this particular series. So from that perspective, I think this is a print which continues to be, from the RBI's policy perspective, it will be taken that the print remains below the lower bound of the inflation target.
Okay. Well, Srijit, welcome to our show. This has it had any impact on the bond market at all? In fact, today we saw the bond yields going down after a long gap. We are seeing a sub 6.6% on the 10-year. How is the bond market likely to react to this number, if at all?
I think the number is definitely favorable. It's lower than what we had expected. So we had, like Suvadip mentioned, we had looked for a slightly higher food number. So our headline number was around 1.7. So this is a positive surprise. But that's it. If you look at the internals, it's primarily the vegetables and fruits and cereals that have probably undershot a bit. And again, it's on gold. So it's a favorable number. But I think that's it. Given the mood the bond market is and what has been happening of late, I think it will be the BOP and the fiscal dynamics that would really shape the trajectory of the bond market. While incrementally, this is definitely a good reading going into the policy. So it basically, sort of backs our call for lower for longer policy rates. That's definitely there. But I think the incremental dynamics would come from fiscal and BOP. And there we are watching, how, for instance, the flows are headed up, what sort of fiscal numbers we are looking ahead, what are the demand supply dynamics shaping up. So we'll probably be looking at, let's say, the union budget. We'll be not just looking at the fiscal deficit numbers, but also, what share of fiscal deficit is getting funded through GSEC borrowings and things like that, and where we are headed in the debt to GDP trajectory. I think incrementally that would probably matter more along with BOP.
Okay. No, I take your point entirely. Not only is this series going to change with a new base year. The February 6 policy will crucially look at the February 1 budget and the deficit numbers, the nominal GDP forecasts on which the budget rests, the tax growth forecasts on which it rests, the dividend expectations from the Reserve Bank. So, there will be too many variables for the February 6 policy to speak about inflation. Devang, what's niggling the bond market? I mean, there isn't even an expectation of a rate cut. In spite of 5 rate cuts today at 6.6%, the 10-year is higher than what it was a year ago. Is inflation becoming, immaterial to the bond market?
Lata, so I think I agree with you largely that somewhere down the line people are not looking at the near-term prints. Everyone starts looking at it from a central bank perspective. Also, we look at 1 year forward inflation. I think people should start getting worried about the rise in commodity prices. You have seen across, I'm not talking about precious metals, I'm talking about base metals like copper, aluminum, all of them have started increasing. So the impact of that going ahead on inflation. Secondly, I think as we just highlighted, I think the more important focus for all bond markets investors would be on what's happening in the budget side. The trade deal is not happening. There can be an additional fiscal impulse possible. So that's worrying bond markets today. And the demand supply dynamics is starting getting skewed. We have just seen the last couple of weeks back, the announcement on the SDLs for this quarter. It's 5 lakh crores. Now, somewhere down the line, the entire demand supply dynamics for bond markets has been taken care of to a larger extent through open market operations. But because there was a lot of front loading of open market operations even in this year, we've seen an announcement of 3 lakh crores in the month of December. I think the bond market investors are starting getting worried that possibly we are entering into a phase where there can be a demand supply mismatch, open market operations, the best of the time for the near term quarter is done, and somewhere down the line the inflation can start inching up. So with a forward looking view, the long bond yields are not actually happy with the lower inflation print.
Wasn't the state bond announcement a little less than what the market expected? I thought that was keeping the markets at least 2 basis points lowered in the last few days.
Our assessment was, Lata, that the bond markets expected SDL announcements to be the tune of around 4.5 lakh to 4.7 lakh crores for this quarter. Internally, our view was also about 4.5, 4.6 lakh crores, and the number was slightly on the higher side. Yeah.
Okay, fair enough. So no joy over there, especially when the SDLs, state loans are as much sovereign, and they're giving you a good 20-30 basis points more than central government securities. So clearly that's keeping the bond yields higher for central government bonds. I'm going to ask the Economist an unfair question perhaps, but you all have been attending all the MOSPI conferences on the new series. So Aditi, what's the expectation going into the new series? We are going to get only 1 year previous numbers, comparable numbers. The MOSPI will adjust the 2025 numbers for us. Maybe they will only give us the 1 month number, that is Jan versus Jan 2025. But what is the expectation? Will it be higher or lower than expected? Lower than the current series?
So Lata, what I've understood is we will get 13 CPI index prints and 1 YOY inflation print. So we will get the full series from January of 2025. I don't think, at least I have not taken away any indication of whether it's going to be higher or lower than the current series. The conference I attended in Delhi, certainly I was not able to take that away, whether we should expect the number to be higher or lower.
Okay. Well, I'm going to ask those questions to the other economists as well, but a mandatory break in order coming back in a jiffy with questions on the new series as well on whether this worryingly low inflation is indicating any worries of lower demand and therefore a pain in the growth element as well. Back in a minute. Welcome back to the special State of the Economy edition. We just got the December inflation numbers, which have come in lower than the CNBC TV18 poll. The headline inflation has come in at 1.33% versus the poll number of 1.62%. Of course, both slightly higher than the November inflation of 0.7%. The food inflation number has come in minus 2.7 compared to the poll number of minus 1.7. So all told, a lower than expected inflation number. I have been speaking with economists Aditi, Nayar of ICRA, Subhajit Rakshit of Kotak, Srijit Balasubramanian of Bandhan AMC, and Devang Shah of Axis AMC. Gentlemen, and Aditi, thank you very much for your patience. Subhadip, before going to the break, I was wondering whether the ultra-low inflation numbers that we have been getting is, giving any doubts about growth. After all, persistent deflation is also a sign of low demand. Any such fears?
Well, yes. I mean, I would not take the deflation part since it's the food prices, and food prices typically has a seasonality to it. It has a base to it. But I think even if you take the core inflation and strip out gold, you would arrive at somewhere around 2.5% odd, anywhere between 2.3 to 2.6. That in itself is low. And it certainly kind of indicates that there is a demand deficit in the economy. That, if you want to corroborate with the nominal GDP growth, that also is relatively low. And I think there is, the indication is that there is a certain slack in the economy. Part of it will reverse when, Devang talked about commodity prices starting to move up, so that will move up. But sustainably, if you are seeing 2%, 3% kind of inflation, I take the indication that there is a slack in the economy, and there are certain indicators beyond the near term, certain prints from the high frequency indicators that we track, which shows that the economy is in a mixed bag. It's not all good, it's not all bad, but certainly some slack is visible in the economy.
Okay. Srijit, the other reason why the bond yields probably fell is because of this expectation that on Jan 14th we could be included in the Bloomberg index. Any talk, is this a major consideration for the bond market?
I think so. If you see the numbers, we are probably looking at 15 to 20 billion worth of flows in a full year. But that would probably be low if you look at the amount of OMOs that the RBI has already done. So 20 billion, if you sort of translates to around 1.8 lakh crore of INR. But the RBI has already done so much of OMOs, so that would probably be one of the factors, definitely. But like I said, there are probably bigger aspects related to supply demand, what sort of replacement demand is coming in with the OMOs, etc., which sort of continues to remain a little lackluster. The high credit deposit ratio, which is sort of probably not helping investments on the margin. And even global concerns, like geopolitics, commodity prices that we just discussed. And what's happening with the US growth, and therefore, for instance, the labor market data that we had recently, and the upside surprise on the US growth data. With respect to that, and even the tariff concerns. So I think that would probably be the major factors. But yes, it's marginally one of the factors that we would look at, and it's probably around 15 to 20 billion a year.
Yeah, 15 to 20 billion, at least it takes away the kind of selling, that, at least counters the kind of selling that we have seen in equities. And I heard a loud buzz about that from 6.63, the fact that the 10-year bond yield has come down to 6.59 is perhaps sparked by this expectation that we could be included in the Bloomberg index, and the expectation is the evening of Jan 14, so we should perhaps know in the morning of Jan 15. Important date. 20 billion is no laughing matter. That's the amount of money, or a little less than that, 18 billion that FPIs took away from equity markets last year. Well, Devang, what is the minimum math expected from the budget? Are you all expecting a much larger demand, a much larger supply of G-Secs? Just broad math, and whether that is also keeping the bond market subdued.
Yeah. So, Lata, as per us, probably we are going across. Now, we all know that from this year, they are not going to probably give a number on fiscal deficit, because now they can transition.
They will give you a market borrowing number.
Yeah. So we are all working with a number of around 16.5 to 17 lakh crores of gross borrowing, and there are around 5.4 lakh crores of maturities, which will translate into closer to 11.5 to 12 lakh crores of net maturities or net borrowings.
Okay. Well, I should have asked Aditi that, since she belongs to a company that rates the sovereign. But out of time, I just want one answer from all of you, monosyllabic. any chance at all that there is another rate cut in this cycle? Swadeep?
Yes, I still vote for one.
One. Aditi?
Definitely not in February.
Okay, but looks like you're still expecting one more in the cycle. Devang?
No, we are on a pause.
Okay. Srijit?
I think again we are on a pause, but only if growth disappoints materially, maybe, but that's not the base case.
All right. So, well, there's one clear expectation, but the others are not entirely ruling out, except Srijit, that there could be a rate cut sometime in 2026 if growth disappoints. But let's hope that's not the reason. Thank you very much, Swadeep, Aditi, Devang and Srijit for joining us and helping us understand the inflation numbers that have just been announced. Important number because it's the last of the old series, so it won't impact policy. We bid goodbye to the series, and from February 12th, we will inaugurate a new inflation series. Thank you very much for joining us on this special edition of State of the Economy. After a break, there'll be more news and updates.